Whether you are planning for growth, preparing for a sale, or simply curious about what your business is worth, understanding valuation is a critical step in making informed decisions about the future of your business. Valuing a business is both an art and a science. It's not just about looking at the revenue and the profit margins. It's about understanding your business's strengths, marketing position, and future potential. The right valuation can open doors to investment, strategic partnerships, and successful exits, while an inaccurate one can lead to missed opportunities and leaving money on the table. Most business owners think their business is more valuable than it really is. Everyone thinks their baby is pretty. Well, today we're going to break down the key factors that impact business valuation and discuss how to maximize your business worth. By the end of this session, you'll have a clearer understanding of how your business is valued. The first thing to know is there's not an MLS in valuing businesses. The MLS works in real estate because there are so few parameters to consider, and they are fairly consistent by region and price range. Businesses, on the other hand, have an almost infinite number of moving parts, and the end results is in the smaller market, there's not enough data to be able to compare apples to apples. So, some of the common valuation problems are listed here. They can include being able to select industry information that's relevant. And then you need to make sure that you've selected the right NICS code, SIC code, which is often difficult in the smaller market. And then many businesses are niche businesses, so it's hard to choose what industry do they belong in. And then revenue size and of course risk. The most common financials that will be used to calculate a valuation are 3 to 5 years and the trailing 12 months of the P&L statements, profit and loss statements, your balance sheet, and cash flow statements. Most business owners in the smaller market use the cash basis accounting to report their financials. The accrual basis of accounting more accurately matches revenue to the expenses incurred during the accounting period, versus the cash basis accounting records revenue when it comes in and when expenses are paid. Most business owners in the smaller market use cash basis accounting to report their financials. The accrual basis of accounting more accurately matches revenue to the expenses incurred during the accounting period, versus the cash basis accounting records revenue when it comes in and when expenses are paid. There are some industries that value a business based on revenue, but the most common is to calculate the value on the cash flow. First, we have to establish a baseline to calculate the valuation. This is done via EBITDA, or seller discretionary earnings, otherwise known as SDE. And normally, it's on the previous 3 to 5 years, always on the trailing 12 months. So EBITDA and SDE measure business performance differently. EBITDA allows buyers to compare the business against others in the same industry by removing expenses such as interest, taxes, depreciation, and amortization. So you have a fair comparison. Seller discretionary earnings tells an individual looking to acquire the business how much free cash is available to operate the business. The goal is to normalize earnings of the business. The most common measure of free cash flow is SDE in the lower market. Every business owner has a set of financials for taxes, but we need to get to the set of financials that shows the true cash flow for the operations of the business. We want to show the buyer what cash is available if they purchase the business, pay themselves the same salary, reinvest, or hire someone. So the first thing we do is we calculate EBITDA, right? The earnings before interest, tax, depreciation, amortization. And then the second thing is we're going to add back owner compensation and other expenses that are not necessary in order to operate the business. These are called add backs. They are expenses on the P&L that do not drive revenue. An add back is any expense that is non critical to the business's operation and will not carry over to the new buyer. They are for the sole benefit of the owner and normally doesn't benefit the buyer or its employees. The most common add backs are owner's salary and benefits. So owners typically are going to pay themselves a salary, distributions, dividends, or draws. And if they pay themselves a salary because maybe they're an S corporation or a C corporation, that can be an add back. Also, most owners have benefits such as health insurance, 401k, life insurance, maybe key man insurance. Some other add backs, as we already talked about, is the depreciation and amortization, interest. Next is extraordinary items, one time expenses that don't reflect the normal business operations. And then perks, personal expenses paid by the business. Maybe that's a car use or meals, entertainment. Maybe there's relatives on the payroll. These are some other add backs that are very common. Rent. Sometimes the business owner might own the building and they might be running through the business below or above the market value of that rent. Also, vehicles, as we talked about, personal vehicles. If the business doesn't use a vehicle to be able to deliver their services or products, it doesn't drive revenue, but they might run it through to reduce taxes, then they can also add that back. Seminars and travel. Sometimes we take trips in order to go to a seminar. That's just to help better ourselves, give us additional education. If it's not needed for the operations of the business, that can be an add back. Club memberships. Many time business owners will join clubs because they need that peer interaction, but it's really not necessary for the operation. And the meals and entertainment. There's some businesses that do have to do entertainment in order to drive revenue, but many do not. And it's okay to run those through for taxes as long as you're talking about business items. And so that is another add back. And then phone and utilities. Sometimes there might be a cell phone that's ran through on the business, but they already have Google Voice or Grasshopper. They already have a phone system in place, but we can run that through again to reduce our taxes. And then personal purchases, and then further employee perks. Sometimes businesses will pay for employee perks that really aren't necessary. What's most important is they're not part of the compensation for that employee. They're not a part of the employment contract for that employee, but they do something nice just because they want to. That can be an add back. So now that we've established a baseline to use to calculate the value of a company, what valuation method is used? Well, there's several valuation methods, but the most common method used for businesses under 5 million in revenue is the market or the income approach. This method involves identifying a group of comparable companies, peer groups, and then analyzing their valuation multiples in order to estimate the value of your company. So, some of the issues with comparative valuations are finding true comparables because no business is the same. They're different in size, location, customer base, operation. So, finding direct comparisons is very difficult. And then market conditions fluctuate. What might have been a multiple 5 years ago is not a multiple today. So it's really important to follow the economic cycles and industry trends in order to understand what are the current going multiples in an industry. And then lack of data transparency. Private company sales data is often very limited. It's outdated or it might be skewed by undisclosed terms. And so in addition, multiples can be misleading because using industry averages doesn't account for a business's unique strengths and weaknesses, otherwise known as drivers of value. And then the seller influence. Some businesses sell at unusually high or low multiples due to owner motivation. If you might have an owner that's burnt out or a distress sale, you're going to see a much lower multiple versus maybe there was a strategic acquisition where you're going to see a higher multiple. So this was a survey that was done by the Value Builder Group, and they interviewed over 50,000 businesses in this survey. And what they found is that the group of owners had an average multiple of about a 3.55. However, those businesses that were under $1 million in revenue averaged a multiple of about 2.86. Businesses that were between 1 million and 3 million in revenue averaged a multiple of about a 3.67. And then those 3 million to 10 million averaged about a 4.42, and 10 million and above was about a 5 times multiple. So you can see that there are other factors in determining the multiple to use in order to calculate a valuation, which in this case depends on the revenue size. The other factor in determining what multiple to use are drivers of value. Think of this as the lens your buyer uses to look at your business in order to assess the risk on your business. Some of those drivers include financial performance. What is your revenue growth? Do you have accurate financials? Do you have strong profit margins? Owner dependency. Is there an over-reliance on the owner, which is very common in the smaller market? And then operational independence. Are there any concentration issues? Do you have a customer that generates more than 15 to 30% of the revenue? Are you heavily dependent on a supplier? Are you overly dependent on an employee, a key employee? And then growth potential. You need to be able to scale. You want to sell a business when it's on a trajectory of growth. Most buyers don't want to buy a business that is stagnant, and especially doesn't want to buy a business that has a decline in revenue. And the growth, and then predictable cash flow. Businesses that have recurring cash flow typically have much higher multiples because they have more predictable cash flow and more of it. Therefore, they're worth more. And then differentiation, the unique selling proposition. Warren Buffett talks about this a lot. What is the moat around a business? Does it have a moat? Is there something that keeps outside competitors and early entrants, new entrants into that business industry from taking the services or the products away from your business overnight? And then customer satisfaction, so important. Net promoter scores, online rankings. Buyers want to see a business that has strong customer satisfaction, has strong customer retention. And then free cash flow, probably the most important. A business that can sustain itself, that pays for itself and generates excess cash flow is worth more to a buyer than one that's just breaking even or worse, has a decline in profit. So now that you know what are the different ways that we value a company, what I want you to do is think about and understand what are your company's strengths and weaknesses, market position, and future potential. So whether you're planning to sell, attract an investor, or you simply want to know where you stand, an accurate evaluation is key to making informed decisions. If you're wondering what your business is truly worth or how to maximize the value, let's connect. I'd be happy to discuss your situation and help you navigate the next steps. To help you take that next step, first, we'd like to offer everyone who's watching this video a free assessment. It takes about 13 minutes, and it's going to give you deeper insights into the 8 drivers of value, and it's going to show you how you can maximize all that hard work that you've already put into your business. So I thank you for your time, and I hope that you've enjoyed this presentation, and I look forward to hearing from you.